has always been more than coins or paper. It is trust, it is memory, it is a record of promises made and obligations yet to be fulfilled. Long before the age of banks and financial markets, human societies sought ways to exchange value beyond barter. Clay tablets inscribed in ancient Mesopotamia recorded debts, contracts, and deposits of grain and silver. In these early records, the essence of banking was already taking shape. The safekeeping of wealth, the transfer of resources, and the assurance that what was entrusted would one day be returned. As centuries passed, money evolved into stamped coins of gold and silver, carrying the authority of kings and emperors. Yet as trade expanded across oceans and continents, carrying coins was dangerous and inconvenient. People turned to institutions that could hold wealth securely and extend credit when needed. In medieval Florence, the Medici family refined the practice of banking into an art. They pioneered double-entry bookkeeping, linking merchants across Europe and laying the foundation for modern finance. The bank became more than a vault. It became a vital intermediary. Depositors placed their money in its care. Borrowers received funds to build ships, start businesses, or purchase land. The bank profited from the difference, the margin between what it paid to savers and what it earned from lending. This simple model of intermediation powered centuries of economic growth. But it also carried risk. If too many borrowers failed, or if too many depositors demanded their funds at once, even the strongest bank could collapse. Trust was both the greatest asset and the greatest vulnerability of the system. Bank runs where crowds gathered in fear to withdraw deposits haunted financial history. To guard against such collapse, governments intervened. Central banks emerged, tasked with stabilizing currencies and acting as lenders of last resort. International agreements like Basel III demanded that banks hold sufficient capital, undergo stress testing, and maintain liquidity to survive shocks. In the United Kingdom, the Financial Services Compensation Scheme guaranteed that depositors would recover up to £85,000 if their bank failed. Such safeguards reassured the public and protected the system from panic. Banks became pillars of stability. They provided mortgages, business loans, investment products, and day-to-day accounts. Their role in credit creation tied them directly to economic growth. Their systemic importance made their survival a matter of national interest. Yet the digital revolution began to challenge this centuries-old order. Smartphones, cloud computing, and real-time connectivity transformed the way people lived and transacted. Regulators opened the door to competition, introducing the Payment Services Directive in Europe and the Electronic Money Regulations in the United Kingdom. Out of this new environment emerged institutions that were not banks, yet offered many of the services people associated with banking. These were electronic money institutions. EMIs did not take deposits in the traditional sense. They could not lend or invest customer money. Instead, they safeguarded funds, issued electronic money, and enabled payments through digital wallets and apps. Their revenues came not from interest, but from transaction fees, currency exchange margins, and premium features. Unlike banks, payment institutions were born digital. They were built on agile systems free from the weight of legacy infrastructure. Account opening was instant, cross-border transfers were cheap, and multi-currency wallets became accessible to anyone with a smartphone. For consumers weary of bank fees and delays, EMIs offered speed, transparency, and convenience. But with innovation came new risks. EMIs were not covered by deposit insurance schemes like the FSCS. If a payment institution collapsed, customers' funds were safeguarded in segregated accounts or low-risk assets, but recovery could take time. EMIs offer a seamless digital-first experience where corporate accounts can be opened within minutes. All onboarding is completed entirely online. In contrast, conventional banks often require lengthy verification processes, with account openings taking anywhere from 6 to 8 weeks. With EMIs, customers enjoy 24/7 access to their accounts, enabling them to check balances, make payments, and manage finances at any time, from anywhere in the world. Unlike traditional banks, there is no need to carry physical documents to a branch counter, as the entire process is streamlined through secure digital verification systems. This makes payment institutions a faster, more convenient, and user-friendly alternative for modern businesses. Fraud surged, especially through authorized push payment scams, where victims were tricked into sending money to fraudsters. By 2023, APP fraud losses in the UK exceeded £500 million. Regulators responded in 2024, mandating reimbursement for victims whether they banked with traditional banks or EMIs, creating a level playing field for consumer protection. The contrast between banks and payment institutions reveals two models of finance. Banks embody stability, offering a comprehensive suite of services, but burdened by regulation and legacy systems. EMIs embody agility, specializing in payments and innovation, but lacking the systemic safeguards that give customers long-term confidence. Technology sharpened these differences. Banks struggled with outdated IT, slow onboarding, and high costs of compliance. EMIs deployed artificial intelligence for fraud detection, machine learning for customer insights, and APIs for seamless integration with third parties. Their user interfaces prioritize simplicity and personalization. Push notifications, spending analytics, and instant transfers redefined customer expectations. Younger tech-savvy generations embraced EMIs eagerly, while older customers often remained loyal to the security and familiarity of banks. Yet digital dependency carried its own vulnerabilities. Outages, cyber-attacks, and third-party failures could disrupt payment institutions overnight. Revolut's service interruptions in 2022 highlighted the fragility of digital-only providers. Banks, though less technologically advanced, maintained resilience through branch networks and traditional systems. The trade-off was clear: innovation and speed versus continuity and stability. Both models carried risks. Banks remained vulnerable to liquidity crises and systemic shocks, as Northern Rock's collapse in 2007 had shown. EMIs, shielded from credit risk by their prohibition on lending, faced operational and technological risks that could lock customer funds in times of insolvency. Consumers learned to balance these trade-offs, using EMIs for everyday convenience and international transfers, but relying on banks for large deposits, mortgages, and long-term security. As payment institutions grew, regulators faced new dilemmas. Should they impose stricter prudential requirements on large EMIs like PayPal, Wise, or Revolut, whose failure could destabilize payment networks? Or should they preserve the light touch regime that fueled innovation and competition? At the same time, banks sought to reinvent themselves, introducing fintech-like products such as HSBC's Global Wallet and forging partnerships with digital providers. The future pointed toward convergence. Banks and EMIs increasingly resembled each other. Banks borrowed digital tools and customer-centric designs. Payment institutions pushed into credit, wealth management, and even cryptocurrency custody. Both experimented with blockchain. Both prepared for the potential impact of central bank digital currencies, which could one day bypass them altogether in retail payments. For consumers, the benefits of EMIs were undeniable. They advanced financial inclusion, lowering barriers for the underbanked and reducing reliance on expensive remittance services. They offered cost efficiency, transparent pricing, and speed unmatched by traditional institutions. Their innovations spurred competition, forcing banks to modernize and ultimately improving services for all. Yet their limitations were equally clear. Without deposit protection, EMIs could not match the reassurance banks offered. Their digital-only models left them exposed to outages and cyber threats. Their specialization meant they lacked the breadth of services that made banks one-stop financial shops. In truth, EMIs and banks were not destined to cancel each other out. They were destined to coexist. EMIs complemented banks, filling gaps in accessibility, speed, and affordability. Banks continued to anchor the system with lending, deposit protection, and systemic stability. Together, they shaped a hybrid financial ecosystem, one that blended innovation with resilience. And so the story of money continues. From clay tablets to smartphones, from vaults to digital wallets, the institutions that hold and move our wealth reflect both our needs and our fears. Banks remind us of the value of prudence and security. Payment institutions remind us of the power of agility and imagination. The future will not belong to one or the other, but to a balance between them. A system that protects trust while embracing change, that safeguards stability while unlocking innovation. The world is increasingly choosing payment institutions over conventional banks, drawn by their speed, convenience, and low-cost digital services that better suit today's financial needs.